What is life insurance? Life insurance is a contract between an insurer and a policy owner. A life insurance policy guarantees the insurer pays a sum of money to named beneficiaries when the insured dies in exchange for the premiums paid by the policyholder during their lifetime. For the contract to be enforceable, the life insurance application must accurately disclose the insured's past and current health conditions and high-risk activities. Types of life insurance. Many different types of life insurance are available to meet all sorts of needs and preferences. Depending on the short or long-term needs of the person to be insured, the major choice of whether to select temporary or permanent life insurance is important to consider. Term life insurance. Term life insurance lasts a certain number of years, then ends. You choose the term when you take out the policy. Common terms are 10, 20, or 30 years. The best term life insurance policies balance affordability with long-term financial strength. Decreasing term life insurance. Decreasing term is renewable term life insurance with coverage decreasing over the life of the policy at a predetermined rate. Convertible term life insurance. Convertible term life insurance allows policyholders to convert a term policy to permanent insurance. Renewable term life insurance is a yearly renewable term life policy that provides a quote for the year the policy is purchased. Premiums increase annually and is usually the least expensive term insurance in the beginning. Permanent life insurance. Permanent life insurance stays in force for the insured's entire life unless the policyholder stops paying the premiums or surrenders the policy. It's typically more expensive than term. Whole life. Whole life insurance is a type of permanent life insurance that accumulates cash value. Cash value life insurance allows the policyholder to use the cash value for many purposes, such as a source of loans or cash or to pay policy premiums. Universal life, a type of permanent life insurance with a cash value component that earns interest. Universal life features flexible premiums. Unlike term and whole life, the premiums can be adjusted over time and can be designed with a level death benefit or an increasing death benefit. Indexed universal. This is a type of universal life insurance that lets the policyholder earn a fixed or equity-indexed rate of return on the cash value component. Variable universal. With variable universal life insurance, the policyholder is allowed to invest the policy's cash value in an available separate account. It also has flexible premiums and can be designed with a level death benefit or an increasing death benefit. Term versus permanent life insurance. Term life insurance differs from permanent life insurance in several ways but tends to best meet the needs of most people. Term life insurance only lasts for a set period of time and pays a death benefit should the policyholder die before the term has expired. Permanent life insurance stays in effect as long as the policyholder pays the premium. Another key difference involves premiums. Term life is generally much less expensive compared to permanent life because it does not involve building a cash value. Before you apply for life insurance, you should analyze your financial situation and determine how much money would be required to maintain your beneficiary's standard of living or meet the need for which you're purchasing a policy. For example, if you are the primary caretaker and have children who are 2 and 4 years old, you would want enough insurance to cover your custodial responsibilities until your children are grown up and able to support themselves. You might research the cost to hire a nanny and a housekeeper or to use commercial childcare and a cleaning service, then perhaps add some money for education. Include any outstanding mortgage and retirement needs for your spouse in your life insurance calculation. Especially if the spouse earns significantly less or is a stay-at-home parent. Add up what these costs would be over the next 16 or so years, add more for inflation, and that's the death benefit you might want to buy, if you can afford it. How much life insurance to buy? Many factors can affect the cost of life insurance premiums. Certain things may be beyond your control, but other criteria can be managed to potentially bring down the cost before applying. After being approved for an insurance policy, if your health has improved and you've made positive lifestyle changes, you can request to be considered for change in risk class. Even if it is found that you're poorer health than at the initial underwriting. your premiums will not go up. If you're found to be in better health, then you can expect your premiums to decrease. What affects your life insurance premiums and costs? Age. This is the most important factor because life expectancy is the biggest determinant of risk for the insurance company. Gender. Because women statistically live longer, they generally pay lower rates than a male of the same age. Smoking. A person who smokes is at risk for many health issues that could shorten life and increase risk-based premiums. Health. Medical exams for most policies include screening for health conditions like heart disease, diabetes and cancer, and related medical metrics that can indicate risk. Lifestyle. Dangerous lifestyles can make premiums much more expensive. Family medical history. If you have evidence of major disease in your immediate family, your risk of developing certain conditions is much higher. Driving record. A history of moving violations or drunk driving can dramatically increase the cost of insurance premiums. Life insurance buying guide. Life insurance applications generally require personal and family medical history along with beneficiary information. You will also likely need to submit to a medical exam and will need to disclose any pre-existing medical conditions, history of moving violations, or DUIs, as well as any dangerous hobbies such as auto racing or skydiving. Standard forms of identification will also be needed before a policy can be written, such as your social security card, driver's license, and/or U.S. passport. Benefits of life insurance. There are many benefits to having life insurance. Below are some of the most important features and protections offered by life insurance policies. Most people use life insurance to provide money to beneficiaries who would suffer a financial hardship upon the insured's death. However, for wealthy individuals, the tax advantages of life insurance, including the tax-deferred growth of cash value, tax-free dividends, and tax-free death benefits, can provide additional strategic opportunities. Avoiding taxes. The death benefit of a life insurance policy is usually tax-free. One wealthy individual sometimes buy permanent life insurance within a trust to help pay the estate taxes that will be due upon their death. This strategy helps to preserve the value of the estate for their heirs. Tax avoidance is a law-abiding strategy for minimizing one's tax liability and should not be confused with tax evasion, which is illegal. Who needs life insurance? Life insurance provides financial support to surviving dependents or other beneficiaries after the death of an insured policyholder. Here are some examples of people who may need life insurance. Parents with minor children. If a parent dies, the loss of their income or caregiving skills could create a financial hardship. Life insurance can make sure the kids will have the financial resources they need until they can support themselves. Parents with special needs. Adult children. For children who require lifelong care and will never be self-sufficient, life insurance can make sure their needs will be met after their parents pass away. The death benefit can be used to fund a special needs trust that a fiduciary will manage for the adult child's benefit. 2. Adults who own property together, married or not. If the death of one adult would mean that the other could no longer afford loan payments, upkeep, and taxes on the property, life insurance may be a good idea. One example would be an engaged couple who take out a joint mortgage to buy their first house. Young adults whose parents incurred private student loan debt or co-signed a loan for them. Young adults without dependents rarely need life insurance, but if a parent will be on the hook for a child's debt after their death, the child may want to carry enough life insurance to pay off that debt. Children or young adults who want to lock in low rates. The younger and healthier you are, the lower your insurance premiums. A 20-something adult might buy a policy even without having dependents if there's an expectation to have them in the future. Stay-at-home spouses. Stay-at-home spouse should have life insurance as they have significant economic value based on the work they do in the home. According to Salary.com, the economic value of a stay-at-home parent would have been equivalent to an annual salary of $162,581 in 2018. 3. Wealthy families who expect to owe estate taxes. Life insurance can provide funds to cover the taxes and keep the full value of the estate intact. Families who can't afford burial and funeral expenses, a small life insurance policy can provide funds to honor a loved one's passing. Considerations before buying life insurance. Research policy options and company reviews. Because life insurance policies are a major expense and commitment, it's critical to do proper due diligence to make sure the company you choose has a solid track record and financial strength, given that your heirs may not receive any death benefit for many decades into the future. Investopedia has evaluated scores of companies that offer all different types of insurance and rated the best in numerous categories. How life insurance works. A life insurance policy has two main components, a death benefit and a premium. Term life insurance has these two components, but permanent or whole life insurance policies also have a cash value component. Death benefit. The death benefit or face value is the amount of money the insurance company guarantees to the beneficiaries identified in the policy when the insured dies. The insured might be a parent, and the beneficiaries might be their children, for example. The insured will choose the desired death benefit amount based on the beneficiary's estimated future needs. The insurance company will determine whether there is an insurable interest and if the proposed insured qualifies for the coverage based on the company's underwriting requirements related to age, health, and any hazardous activities in which the proposed insured participates for. Premium. Premiums are the money the policyholder pays for insurance. The insurer must pay the death benefit when the insurer dies if the policyholder pays the premiums as required, and premiums are determined in part by how likely it is that the insurer will have to pay the policy's death benefit based on the insured's life expectancy. Factors that influence life expectancy include the insured's age, gender, medical history, occupational hazards, and high-risk hobbies. 4. Part of the premium also goes toward the insurance company's operating expenses. Premiums are higher on policies with larger death benefits, individuals who are at higher risk, and permanent policies that accumulate cash value. Cash value. The cash value of permanent life insurance serves two purposes. It is a savings account that the policyholder can use during the life of the insured. The cash accumulates on a tax-deferred basis. Some policies may have restrictions on withdrawals depending on how the money is to be used. For example, the policyholder might take out a loan against the policy's cash value and have to pay interest on the loan principal. The policyholder can also use the cash value to pay premiums or purchase additional insurance. The cash value is a living benefit that remains with the insurance company when the insured dies. Any outstanding loans against the cash value will reduce the policy's death benefit.